there's been challenges around insolvency resolution process. There've been growing shadow of NPAs. There've been failed business models, failed corporations, stretched promoters, a lot of credit squeeze in the system. And to add more spice to it, I think the regulators are also keeping awake and keeping pace with the changes that is sweeping around, and then the regulations continue to get tighter and tighter with every passing event. And as though these are not enough, we also have for distraction the political commentary and the largest dance of democracy. So it's in the backdrop of all of this that the company has reported very satisfactory outcomes on all its targeted deliverables. Before I get into the details, the usual disclosure that we make in terms of disclaimer actually, in terms of forward-looking statements that we could make in the course of this presentation. The summary of our performance for FY19, and I'm talking about the year as a whole and not Q4, in the context of the annual results. The order inflow has grown by 16% over the order inflow that we won in the previous year. Consequently, the order book has grown by 12%. The revenues have grown by 18% vis-a-vis the previous year. EBITDA has grown by 20%, which is marking the profitable growth. And consequently, the profit after tax is up by 21%. These are the highlights in terms of our performance. Looking at the specifics, start from the order inflow, and let's look how the Q4, which was icing on the cake insofar as the year is concerned, went by. We had a order intake of 565 billion rupees, which is a 14% increase over the order intake of Q4 of the previous year. And as you can see, the domestic orders have actually been a touch disappointing in the context of Q4, as against 409 billion rupees of the previous year. We've clocked about 388 billion rupees of fresh orders in the domestic markets for Q4, a 5% reduction. But more than made up by the international order intake. From 87 billion rupees in Q4 of the previous year, we ended the year ended the quarter March 19 with almost double the volume at 177 billion rupees. So overall, a quarter ended on a happy note with 14% increase and at 565 billion rupees. Switching over to the year as a whole, we did one better. The orders that we won during the year is 1.7 trillion rupees, up 16% over the 1.52 trillion of the previous year. And both the domestic orders as well as the international orders have grown in this period. The domestic orders grew from 1.1 trillion to 1.3 trillion, and the international orders grew by about 14% from 359 billion to 468 billion. The end of the year, the share of international orders is about 625 billion. In terms of order book, we ended the year with 2.63 trillion rupees, of which the domestic order book is about 2 trillion, with 625 billion coming in from international. So roughly about 22% of the order book is international. In the context of order inflow, though, 26% of the orders that we won during the year FY19 came from international markets. The orders largely came from, obviously, the infrastructure sector, which is a big sector. Hydrocarbon business contributed handsomely to the order inflow, particularly the international order inflow. We also had a good year in terms of heavy engineering business picking up orders, and the other businesses such as defense, etc., as well pitching in. In the context of our disclosures, the services business, the revenue of the services business are added as orders for the group as a whole, and the services business doing well has also reflected in better order inflow for the group. The order inflow composition, 54% of the orders of 1.76 trillion rupees comes from infrastructure sector. Hydrocarbon, which has had a good year, joins the party, so to speak, from being a single-digit share of the pie to about 15.8%. And the services, as I spoke to you just now, adds to about 18%. It's important to also recognize the fact that thanks to the spate of airport orders, and once again, we have won all the interesting airport orders on offer, actually has contributed to the private sector capex beginning to look up just in terms of percentages. The ratios are moving more towards private sector. Of course, there has been some orders in the area of health as well, and in commercial real estate. So consequently, the share of private sector orders are just beginning to look up as compared to the past. The order book composition, as I mentioned, 2.93 trillion rupees of orders is where in the book we need to execute them over the next 2-3 years. And infrastructure accounts for 2.2 trillion out of the 2.9 trillion rupees of orders. And hydrocarbon follows with about close to 400 billion rupees of orders. The other segments are smaller and hence not very significant in the context of the order book commentary. The performance in specific, the revenue earned by the company at 1.4 trillion rupees is up 18% as compared to the 1.1 trillion of the previous year. And for the quarter 4, the revenues at 449 billion rupees is also up 10%. 32% of the revenues come from international business, and it's pretty similar to the 33% that we recorded in the previous year. The manufacturing, construction and operating expenses are up 19% at 919 billion rupees and 15% for the quarter at 311 billion rupees. The financial services business uses money as raw material, so the cost that they incur in sourcing the money is classified alongside the manufacturing and operating expenses of the group. And hence, the financial charges incurred by the financial services business at 74 billion rupees is up 23% for the year as a whole, and up 25% for the quarter at 20 billion rupees. The staff cost for the group as a whole, and the group currently employs about 140,000 people, is at 181 billion rupees, up 19% as compared to the staff cost that we incurred in the previous year. Much of the additions that we made during the year, which is about 7,000 statistically speaking, came from services business between information technology, engineering services and financial services. The sales and administration cost at 73 billion rupees for the year FY19 is down by 4%, and a similar trajectory of a downward trend is also visible in quarter 4, and the reasons largely being that in the previous year, both quarter 4 as well as the year as a whole, we had made provisions for certain receivables which seemed doubtful or delayed, and we made considerable progress during the current year in recovering those, and consequently we had the benefit of reversing some of those provisions, and hence we are able to report a better than usual trajectory in terms of comparative cost of sales and administration. The total operating expenditure of the group at 1.2 trillion rupees is up 17%, and for the quarter 4 at 393 billion is up at 12%. EBITDA consequently is at 163 billion rupees, which is up 20% as compared to 136 billion of the previous year. And in the context of the margins, they are up by 20 basis points from 11.4% to 11.6%. The group earned other income of about 19 billion rupees, largely arising out of treasury investments of the surplus funds. And the group also incurred an interest cost of about 18 billion rupees. So virtually the interest cost got financed by the other income that the group earned, leaving the EBITDA generated by the business intact. The depreciation at 21 billion rupees is normal. There is nothing extraordinary to report, and they follow the trajectory that has been featuring the asset capitalization that we've been doing as a group. We have an exceptional item of 3 billion rupees. This is largely on account of the progress that we have made in the case of Bhushan Steels, where thanks to the NCLT resolution, we've been able to write back the provisions that we made, anticipating the worst. But I'm happy to report that the resolution proposal has worked in favor, and we are in the process of recovering these dues. So consequently, the reported profit after tax at 89 billion rupees is up 21% as compared to 74 billion, and on a more modest 8% when it comes to Q4 at 34 billion rupees. The segments, as you all know, there's no change in the way in which we are reporting the segment, except as to what we announced at the beginning of the year, that the shipbuilding was made part of the defense engineering, and hence they were decongesting the other segment, which originally used to have shipbuilding as well. Looking at the individual performance of the segments, infrastructure segment, the biggest by a large, has reported a revenue of 724 billion rupees, up 16.3%. For the overall growth of revenues for the group at 18%, the 16.3% growth in infrastructure revenue is a very significant contributory. Of the 724 billion rupees, 191 billion rupees are revenues that we earned from executing international contracts, and they are up by 5.3%. The EBITDA margin has declined by 130 basis points from 9.8 to 8.5, largely reflecting the stage in which the various jobs are under execution, as well as certain cost provisions that we've been carrying in respect of the time and cost overrun that we have had in the transportation infrastructure business. As we normally do in our accounting policies, the costs are booked upfront, and the claims and the reimbursements that come in much later are accounted through the subsequent quarters. Looking at the power segment, the segment continues to have challenges in terms of being able to get enough opportunities to fill its capacities to optimum. And for the limited opportunities that come by, there have been considerable competition for these opportunities. So consequently, the order intake of the segment has been more modest than what we would like to do. And the low order intake resulting in low order book results in the decline in revenue by 36% for the year, from 62 billion rupees to 39 billion rupees. The segment carries very limited fixed overheads, so consequently the EBITDA margin is still being able to shore up at 4.5% as compared to 3.4% of the previous year. But for the long-term health of the segment, it is very important to win orders to keep the capacities going. When we report these margins, it should be borne in mind the joint ventures that we have for boiler and turbine manufacturing are not consolidated at line item level of sales costs and EBITDA. They are consolidated only at the profit after tax level. Hence, the profits that these JVs make are not reflected in the EBITDA margin,